Hi, everyone. Thanks so much for joining on this Market Live. So much going on, right? Who would have thought just a few weeks ago that Greenland would be so central to financial markets and investors' decision making, but it is. We're going to dive straight into the charts. Let's just go with it. Some of you may have read my week ahead, but you will have seen that over the weekend, a serious feud is broken out between Trump and Europe regarding Greenland. Obviously, Trump wants to buy Greenland, really, although it's not up for sale. And Europe has responded by bringing troops into Greenland. Now, ostensibly, that's not designed to fight America. It shouldn't get to military action, and we don't think it will. It was designed just to protect Greenland, really, from other threats like China and Russia. But Trump got really angry about this and slapped on 10% extra tariffs, which will come into force next month, against the 8 countries that did put troops there, including the UK. So today we're seeing the diplomatic fallout. Now, it doesn't help. There's a bit of radio silence in the US because, yes, futures markets are open in the US. You can see futures pricing moving, but actual markets are closed for Martin Luther King Day. So there'll be no trading on cash equities and no trading on the bond market either for the US. So US is closed, but look at the sea of red in Europe. If you follow my pointer, really a big down day, particularly for the Euro stocks, the CAC, the DAX, they're all down more than 1%. The FTSE is not doing too badly, and that's because where is the money flowing to during this period of geopolitical tensions? It's flowing into the gold price. As you can see here, if you follow my pointer, gold at $4,663 an ounce, still just surging forward along with silver, which is up 30% already this year, up another 3.5% today. Silver is trading above $93 an ounce now, so some huge moves. But just look at that. Gold, absolute surge. Whenever we're seeing risk, a geopolitical risk, particularly geopolitical risk that's emanating from the US, then that is seeing some upside on the gold. And the only thing I think will weigh on the gold price really in the near term is if Trump backtracks from these tariffs. If he says that he's going to take a bit longer and try and negotiate a deal for Greenland. And let's face it, what he wants is their rare earth minerals, although if you read some articles, they say that they're not quite so easy to get from Greenland. So it's hard to know what exactly he wants. But in this very unusual period, with a president who is very unorthodox and pursuing very unorthodox foreign policies, the money is piling into gold, and you can see that. I mean, a nice rise. If we look at silver, just bear with me, guys. I'm just going to bring up the silver price. Silver is just parabolic, but it has been really since November. So December, we saw loads of money pile into silver, and we know there's a lot of retail interest in silver as well. I think part of that is the AI trade. Silver is very important for chips, for AI chips. But now you've just got another impetus. So the AI theme is still ongoing, although it is morphing, as I mentioned in my week ahead. But this, the silver and gold are really what is attracting interest in these periods of geopolitical uncertainty. Now, if we just look at bonds as well, we did mention today that you should really look at the bond market, but obviously the US is closed. We've seen a very mild reaction actually elsewhere. So I think tomorrow, Tuesday, is going to be where we're going to need to see how the bond market reacts. Now, if I just go on to a 1 week, you can see that in 1 week, US Treasury 10-year yield rose 4.8 basis points. That was last week. So if you remember what Trump was doing last week, he was threatening to strike Iran, and he was also, the chairman of the Federal Reserve came out and said that the president was threatening Fed independence. Now, that is absolutely huge, you'd think, for bond yields in the US, and actually it had a very small move, a very mild move to the upside of 4.8 basis points. So the market's been incredibly resilient, but as we're seeing, we're not seeing a rout in stock markets at all, but we are seeing quite a lot of negativity flow through. So that is just something to watch there. Bond markets do tend to move in unison. We would point out, if you just follow my pointer down, Japanese bond yields have absolutely surged. Now, the reason for this is that there's been an election called for the 8th February in Japan. This was well priced in, but there's also now expectations that if the current Prime Minister of the Liberal Party doesn't get in, then that could actually make it much easier for the Bank of Japan to raise interest rates. So hence, we've seen Japanese bond yields rise. And if you just bear with me, I'm just going to show you the 10-year Japanese bond yield, which is surging. Now, this is a very long-term chart. It goes all the way back to 1988. So we are currently at the highest level since 1997. Now, it's just worth thinking about. Back in 2023, US yields were on the rise, and it broke something, right? It broke the Silicon Valley Bank, which had a bit of a knockout, caused a little bit of volatility there back in 2023. If you're seeing this big rise in yields and they're moving to multi-decade highs, something could break in Japan as well. So that's just something to watch out for. Obviously, we've got the US and we've got all the geopolitics going on in the US, but don't forget about the rest of the world. And I think right now the market is incredibly sensitive to geopolitics, events in Iran, what's going on in the Middle East, but it could also be Asia. Don't let that fall from your radar, because if there was to be, I don't know, I'm plucking this out, by the way, this does not mean it will happen. Let's say a small bank in Japan collapses because of the rising interest rates, and they've just got too much of this, or too many Japanese bond yields on their bonds on their balance sheet. And of course, as yields rise, bond prices fall. Let's just say something like that happens, or to a hedge fund out there or something like that. It'll be interesting to see the knock-on effects, because I think the markets are very, very sensitive. So if there was a market event in Asia, I think that would have an impact on overall market sentiment. So yes, we've just got to keep our minds on many different things at the moment and make sure that we don't miss out on anything. Now, I just want to show you what's moving markets. Now, this is the FTSE. It's the year-to-date performance of the top 10 and the bottom 10 performers. So Associated British Foods, that's the owner of Primark, they're down 12% year-to-date. They had a really horrible trading update earlier this month. And then we've got Beazley, BAE Systems, Babcock. We've got Glencore. Remember, Rio Tinto's making a move with Glencore. We've got Fresnillo, big silver and gold mine. I've got Rolls-Royce there. So the big movers, what is propping up the FTSE 100 are the likes of BAE Systems, Rolls-Royce. Rolls-Royce is up 11% year to date. BAE Systems up 22, a fifth. Babcock International up by a fifth just this year. So that really shows you how the market is reacting to this geopolitical threat, which is emanating from the US. No one really would have thought that would be the case so far this year, but that is definitely something there to watch, because the overall FTSE is only up 2.6% or just under 2.7% year to date. When we look at the Euro Stoxx index, now I'm just looking at it today. As you can see, not much is moving higher in the Euro Stoxx index today. Only out the Euro Stoxx 50, we've only got 7 stocks that are in making gains, some of them really, really tiny. But look, Rheinmetall up 2.34%, Bayer up 6.8% as well. So, but look at the losers today. We've got Louis Vuitton, we've got LVMH, we've got Adidas, we've got ASML, we've got ENI, we've got Volkswagen, we've got Mercedes. So look at the companies that are falling. They are the luxury goods companies, which are going to get hit really badly by more tariffs from the US. We've got car companies, they're also going to get hit. And of course, then you've obviously got, Adidas as well. So these companies that are really, and brands that are really linked globally and really rely on the US as a consumer, absolutely getting hammered. Obviously not good at all. Now, if we just take a quick look and just segue into the currency market, because really this extra risk, geopolitical risk, is really being priced in across markets today. The dollar is actually lower. If you look on the right-hand side here, the dollar is coming off quite sharply. It's testing the 50-day moving average at 98.99. Now, it's not been a rout, as you can see, but it is fairly, it certainly is a move to the downside. If we just look at what currencies are doing today. So as you can see, the dollar is the weakest currency in the G10 FX space. All the G10 currencies are higher than the dollar, which is the base currency in this diagram. And the pound is one of the weaker performers, so it's in the bottom half. It's only managing to eke out a 0.23% gain. But the euro, interestingly enough, that's up a bit more than that. And obviously the Swiss franc is leading the charge higher against the yen. We're not seeing massive moves, but I do think it's really interesting. Certainly what the FX market is telling us is that investors are once again shunning the dollar. Now, you don't often see moves of like 1% plus in the currency markets. You see that much more frequently in equity markets. But what we are seeing is certainly the signs that if not sell America, it certainly is sell the dollar, as Donald Trump's antics certainly seem to be eroding support for the world's most traded currency, which could lead us to down many number of paths. But I think the fact that the Swiss franc is leading the charge and the yen isn't, obviously the yen is coming under some pressure because of those rising bond yields and domestic issues at home. The Swissy, well, firstly, it's not a NATO member, it's a neutral country. So that may also be a reason why the Swissy is attracting more inflows. And actually, I'm quite favourable of the Swissy right now, because the risk is with Greenland. Greenland is it's a self ruled state, but it is part of the Kingdom of Denmark, and Denmark, of course, is a NATO member, so it's by proxy is a NATO member as well. So if the US was to go in and try and take the sovereignty of Greenland in whichever way that may come about, if it does that, then you would essentially that would be the end of NATO, which would make Europe much more risky to invest in. It could hurt growth. It could make it much more open to Russian attacks or to attacks from many different places. So it would just definitely could weigh very heavily on Europe, and it would be the end of the Second World War security order, essentially. So it would make the world a much more dangerous place, and that would be reflected in financial markets. Now, before I let you go, I just want to show the VIX, which is the US volatility index. Now, the US volatility index had been trading at about 15 at the end of last week. So it'd been trading at 15, it's now jumped to just under 19. So one thing I want you to see is that 15 is historically low. The average for the year so far is 18.84, and we've just gone back to the average today. So obviously US markets aren't open, cash stocks aren't open, but the VIX is still trading. And we've seen that kind of jump, as you can see here. If you just follow my pointer, you can see a big jump higher in the VIX index, which was totally expected. When volatility is so suppressed, it's going to have a big reaction to events like this. Now, it's all about the news flow this week, guys. It's all about Davos as well. Remember, Donald Trump is going to Davos on Wednesday and Thursday. He's going to give a big speech. He's also going to meet with European leaders. If he backs away from those tariffs for Europe, then I think we could see risk recover. But if he doubles down on it, that's going to be a different thing. Remember, the US is out on holiday at the start of this week on Monday, so it could be a rough. That's one of the reasons why everything is kind of sold off. No rout in the markets, absolutely not, but a lot of uncertainty out there, and volatility is certainly moving north after a very suppressed period. But thank you all so much for joining, and good luck trading this week.